Today, we're diving into one of the most powerful tools for wealth building: SIP mutual fund investing. You've probably heard the term SIP tossed around in financial discussions. But what is it really? And more importantly, how can it help you grow your wealth, steadily, safely, and smartly? Let's explore the journey of SIPs and how they can transform your financial future. What is SIP? SIP stands for Systematic Investment Plan. It's a method of investing a fixed amount regularly, usually monthly, into a mutual fund. Think of it like planting seeds in a garden. Instead of dumping all your seeds at once, you plant them steadily over time. With care and patience, they grow, and the same is true for your investments. With SIPs, you don't need a lump sum to start investing. You can begin with as little as $500 per month. That's what makes it perfect for beginners and seasoned investors alike. Why SIPs work? Here's why SIPs are so powerful. Dollar cost averaging. When markets are high, your SIP buys fewer units. When markets fall, it buys more units. Over time, this averages out the cost and reduces the risk of timing the market. Power of compounding. SIPs help your money grow exponentially. The longer you stay invested, the more your earnings generate further earnings. Discipline and consistency. SIPs promote the habit of saving. Since the investment happens automatically every month, it removes emotion and market fear from the equation. Example of SIP growth. Let's say you invest $5,000 every month in a mutual fund via SIP for 20 years. Assuming an average return of 12% per year, your total investment of $12,100,000 could grow to over $50,100,000. That's the magic of consistency and time. Now imagine if you increase your SIP amount as your income grows, your wealth could multiply even faster. Choosing the right fund. Not all SIPs are created equal. Choosing the right mutual fund is critical. Here's what to look for. Your goal. Are you saving for retirement, a house, or your child's education? Risk appetite. Equity mutual funds offer higher returns with more risk. Debt funds are safer but offer lower returns. Fund performance. Check historical returns, fund manager experience, and ratings from trusted platforms. Popular SIP-friendly fund categories include large cap equity funds, index funds, ELSS, for tax saving, balanced or hybrid funds. Common SIP myths. Let's bust a few myths. Myth 1. You need a lot of money to invest. Truth. You can start with just $500 a month. Myth 2. SIPs give guaranteed returns. Truth. Returns depend on market performance. SIPs reduce risk, but they don't eliminate it. Myth 3. You can't stop or change your SIP. Truth. SIPs are flexible. You can pause, increase, or stop them anytime. Best practices. Want to get the most out of your SIP? Start early. The earlier you start, the more time compounding has to work. Stay consistent. Don't stop SIPs during market downturns. They're actually when you accumulate more units. Review yearly. Assess fund performance and adjust if needed. SIP mutual fund investing is one of the smartest, simplest ways to grow wealth over time. It's not flashy. It's not fast. But it works, steadily, silently, and successfully. Whether you're saving for retirement, your child's education, or financial freedom, SIPs can be your loyal partner on the journey. Remember, wealth isn't built by chance, it's built by choice. And choosing to invest regularly through SIPs is one of the most powerful choices you can make. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more insights on smart investing. Let me know in the comments, are you already investing via SIPs, or planning to start soon? Thanks for watching and keep investing in your future, one SIP at a time.